The Smoot-Hawley Tariff Act of 1930 stands as one of the most infamous economic policies in U.S. history, widely regarded as a contributing factor to the worsening of the Great Depression. Sponsored by Senator Reed Smoot and Representative Willis C. Hawley, the act was intended to protect American farmers and industries by imposing high tariffs on imported goods. However, rather than bolstering the U.S. economy, it triggered a wave of international retaliation, severely restricting global trade and deepening economic hardships. At its core, the Smoot-Hawley Act raised tariffs on over 20,000 imported goods to record levels, with the goal of shielding domestic industries from foreign competition. The idea was that by making imports more expensive, American consumers and businesses would buy domestically produced goods, thereby supporting local industries and preserving jobs. However, the policy backfired almost immediately. Other nations, particularly major trading partners like Canada and European countries, responded with their own tariffs against American exports. This led to a drastic decline in international trade, exacerbating the economic downturn that had begun with the stock market crash of 1929. One of the most damaging consequences of the Smoot-Hawley Tariff Act was the collapse of global markets. U.S. exports plummeted, causing significant losses for American manufacturers and farmers who depended on overseas markets. Countries that had previously imported American agricultural products turned to other suppliers, leaving U.S. farmers with surplus crops and declining prices. This agricultural crisis compounded the financial struggles of rural communities, many of which were already facing economic distress. The act also intensified tensions between the United States and its trading partners, weakening diplomatic relations during a period when international cooperation was crucial. Economists and historians widely agree that Smoot-Hawley worsened the Great Depression by restricting trade at a time when economic recovery depended on global commerce. Despite early warnings from economists, business leaders, and even some members of Congress, President Herbert Hoover signed the bill into law, bowing to protectionist pressures. The economic fallout was swift, and by the mid-1930s, the U.S. government recognized the need to reverse course. The Reciprocal Trade Agreements Act of 1934, championed by President Franklin D. Roosevelt, marked a significant shift in U.S. trade policy, allowing the executive branch to negotiate tariff reductions with other nations. This helped to slowly restore global trade relations and laid the foundation for more cooperative economic policies in the post-World War II era. The Smoot-Hawley Tariff Act remains a cautionary tale about the dangers of protectionism and the unintended consequences of economic isolationism. It demonstrated how short-sighted policies designed to protect domestic industries can, in fact, harm the very economy they seek to support. The Act's legacy continues to inform trade policy debates today, serving as a reminder that tariffs and trade restrictions can have far-reaching and often detrimental effects on economic stability and international relations.